In this video, we'll talk about smart stops versus random stops. Folks, it is important to know where the stop loss is. The last thing I do is to call a trade or do or get into a trade without knowing my exact stop. That being said, let me explain the difference between how most traders look at the stops versus an educated trader. Let's assume your stop loss randomly or typically stays at 30 pips. Let's assume you're doing three contracts because I like to do three contracts for reasons for management purposes. Times three, okay, that equals 90. So you're risking 90 pips for a stop loss. Let's assume you get stopped out three times a week, only a week, times three, times 90. That is 810 ticks a week risk. Let's assume you're doing $5 per pip, for example, or even $1 per pip. That's $810. Okay, times 52 weeks. That is 42,000, folks, in stop outs and losses. That's getting stopped out three times a week with your average 30 pips a stop on three contracts. If I show you a way to reduce your risk from 30 pips random to 10 or 15, let's do 15. 15 times 3 times twice a week, or times 3 times a week, sorry. That's 135 pips times 52. That is $7,000. So minus 42,000, there's a saving of $34,000, folks, if I did the math correctly. It is very important to take care of your bottom line of your stop loss and reduce it according to the logic. And the logic behind volume profile is this: if the market goes into this level beyond a certain amount, it has no reason to stop all until the next continuation zone. So if you know your continuation versus rejection, why would you have a stop loss here, right? Why would you have a stop loss here? Meanwhile, you can have your stop loss here. And why would you take a trade from, if it breaks down lower and it comes back here? For example, this was a good level, by the way. Stop loss would have been here. But if it comes back down here, why would you take a trade from here rather than waiting for it to poke into this area? These are all detailed in the education, right? And if I go to a smaller chart, for example, right now, you notice how the market moved. If I go further down, and you see how the market stopped here, here, and bounced back up a few times. Why would I have a stop loss anywhere in this area? Meanwhile, if it comes below this level, it's going to continue much lower all the way down. So knowing this, I would rather cut my losses and have a stop loss at 4,000, for example, here, this number, instead of 20 pips lower. Again, there's a lot of details good into this, a lot of practice, but for that amount of saving, it is important to learn this. Anticipate, confirm, execute, folks. It's key to being successful in trading. You have to anticipate the move. You have to know where your stop loss is before you trade it, and you have to confirm it. Okay.